Hello, good morning, good afternoon, or whatever time it is, wherever you are. My name is Kyle Teixeira. This is my father, John Teixeira, and we are TPM, local property managers in DFW and real estate experts bringing you our best advice accumulated throughout the years and from our experience. So let's get into it. This week, we are going to be talking about appreciating your appreciation. So if at any point during or throughout this podcast you're excited as we are to start building wealth through real estate or interested in the topic or have any questions for us, send us an email at showmethemoney@wearetpm. You can always give us a call too at 817-818-9147, and we'll be happy to talk with you, look over your portfolio, schedule a consultation, whatever you want to do, just so you can start building wealth for you and your family. So let's get into it.
What's up, Kyle?
I don't know. What is up? It looks like a beautiful day out here in the podcast studio.
This is one of my favorite topics, isn't it?
Appreciating your appreciation.
Yeah, this is something I talk to with our potential clients and our current clients all the time. So this is,
I'd almost call it our favorite lecture. Right?
Our favorite lecture. Okay. Well, this is why you do what we do, right? So if we could start the topic, I'm going to try to audibly describe a chart that I've been using to help paint this picture for people, right?
What do we call that chart?
It's a wealth building chart.
Building wealth with real estate.
Building wealth with real estate, exactly. And you guys hear us say these things all the time on our podcast. It's interesting that we're doing this, followed up by our Orange Beach podcast and some of our short-term rental podcasts. Those are for the cash flow minded. We're going to talk about that. The cash flow minded people, right? But they still have this appreciation that we're going to talk about built into it. So let's get into it. This chart that I'm talking about really paints a picture of how with real estate you build long-term wealth. Mm-hmm. And everybody wants to talk about and focus on what we would call cash flow. So if you draw a line across a piece of paper, if you're listening to this in the car or something, just visually draw a line across and that's your expense for 30 years, right? Assuming you have a fixed rate loan, that is what you're paying, what your payment is. If you have a loan on that investment for 30 years or 20 years or whatever you get it for.
Yeah, I mean, let's set the foundation a little high level a little bit more. When we're talking about your real estate investment, we're looking at your return on investment, right? So we're looking at the two major factors people consider and sometimes appreciate or don't, and that's why we're calling this appreciating your appreciation. So,
absolutely.
And those two factors are cash flow and appreciation. So.
Absolutely.
And what you were saying is you have a baseline mortgage payment that goes into that consideration of how much this investment's going to cost you every month, right? And basically doesn't change over the life of the 15, 30-year loan, right?
Yeah, and I start there because that's what people want to focus on, right?
So
what is this going to cost me?
We're looking at a line that goes from 0 to 30 years, right?
Right, and then it goes away.
Yeah.
I mean, most people don't have a loan for a full 30 years or whatever. I've got most of my rentals on 10, 15, or 20-year loans, depending on where they are. When I refinance, well, this is a side note, but when I refinance, I don't like to waste the interest, the equity I'm building by paying down the upfront interest that I just got done doing. I don't like to waste that by rolling into it and starting over and doing it again. Yeah. So if I'm going to refinance a 30-year note and I've been paying it for 10 years, I'm going to refinance it for at least 20 years so that I'm not starting that process over again. Well, technically, I still am, but...
Yeah, but we're setting the foundation of an investment mindset here. So let's use examples and make this easy. So you got, let's say we have a 30-year loan, $100,000 property, and just call it our mortgage and escrow. Total payment per month is $1,000.
Let's be more realistic because we like to use $100,000 because it's simple, but you can't find one of those anymore. Let's use a $200,000 house, which you can barely find one of those anymore.
We still using $1,000 a month, or are we going to use $2,000 a month? Let's use $2,000 a month, $200,000 home price. How about that? All right. Because you got taxes in Texas and all that stuff. So that baseline, $2,000 a month from year 0 to year 30, your cost on this investment is $2,000 a month, right?
For as long as you have that note.
When you're considering it, your return on that investment would be let's start with cash flow. You're looking at your cash flow. You want your incomes on average to exceed that $2,000 a month. Let's call it $200 of cash flow, $2,200 a month coming in. You got $200 of cash flow in your pocket. Now, we're not looking at a straight line with rental rates either. Over 30 years, especially, that $200 a month, while your $2,000 is not changing, your rental rates in all areas will go up, right? So that cash flow will grow incrementally over the years. And what do we call the cash flow? Cash flow's your...
I call it kind of like your bonus money, right? Mm-hmm. It's capital that we use to build our empire. That's what I use it for. That's what I try to teach people to use it for. And we're going to get into that a little
dividends.
Bit. Well, okay, so dividends, so fine, but that was a really good description, Kyle. So there's a small gap there that grows over time. Was the picture you were painting was. You have that straight line, $2,000 a month. We're renting for $2,200 to start off with, and we have a house worth $200,000 at the very beginning of this line. And as the years go on, that $2,200 becomes $23,000, becomes $25,000, becomes $28,000, but our payment is still $2,000.
Mm-hmm.
So our cash flow grows over the years and gets bigger and bigger and bigger. And that's what you were just describing.
Yes, and we're using a tiny example. Let me throw in that we know that taxes and insurance can adjust that monthly rate a little bit and grow a little bit, but it won't grow near the rental rate, right? But what we're talking about here is what needs to be appreciated in appreciation is equity, right? And how you have equity is the difference between your debt on an asset versus its value, its market value, right? So when you started out that loan, let's assume that you got a 0% down payment just for simplicity. Obviously you didn't, maybe VA, whatever. So you start with $200,000 in debt of that asset. It's worth $200 because you just bought it. That's zero, right? But as those 30 years go down and you're making that $2,000 a month monthly payment, that mortgage principal is on the opposite side of that chart, or the bottom side of that chart, where it's going down, right? So how much should you owe on that property after 30 years?
Okay, okay, so now you're describing two things at once. So let's split that up for everybody because it's a little bit harder when you're listening to this. The top of that chart that we're talking about is your value, right? So that $200,000, the value of your home goes up and up and up and up.
Got to that part yet.
Okay.
But yeah, that's the point, is your mortgage principal goes down to zero.
Yes.
Right? Over that 30-year term, while your value starts at $200 and goes up to, say, after 30 years, $400,000, right? So when you started with zero equity and you're paying towards a $200,000 debt, they grow parabolically away from each other is really what we're getting at. That, you started at zero, now you have $200,000 paid off after 30 years and a $400,000 property. Well, you have $400,000 in equity, right? So appreciating that appreciation is key to any analysis or looking at the success of a real estate investment, because it's not all about cash flow. Cash flow, while you call it the bonus, is because you just generated $400,000 in equity after that example. That's
Exactly.
a good investment.
It's because when I look at that chart and I look at the difference between my current value and my current principal balance on my loan, that is where my wealth is built. And when I look at that chart and I see the difference between those two, that cash flow on that same chart looks like nothing compared to the wealth I built in appreciation, right?
Yeah, and we've talked about in previous episodes how you can reinvest that cash flow to grow that part of the analysis. But ignoring that, you call it a bonus because that whole value equity conversation we just had, that alone, if you were making an investment in, say, an equity or something else, that would be a great return, right? $200,000 return over the life of this investment, that's double, 2x, like it's a pretty good investment consideration. And then you add on top of that, hey, well, I'm also getting this bonus payment out of this investment every month or every whatever your disbursement section is. So, and we call this a lecture because when you don't appreciate your appreciation, you'll never appreciate the fact that a zero cash flowing property is still likely making you a lot of money. We've heard that argument many times. If I'm only cash flowing $100 a month, is this worth it? Well, the value. Let me sit down with you and show you the value at December 31st of last year was say $250,000 for your property, and here we are a year later looking at it in December, and now it's $320,000 for your property. So yeah, you made zero in cash flow over the year, but you made $70,000 in appreciation. Does that sound like a little bit of money? Not if you appreciate the appreciation.
Yeah, and to your point, the reason we quote unquote you're referring to it as a lecture is because we constantly have to remind people that people focus, investors typically have a tendency to focus on their cash flow, right? Steve over there behind the board over there, he's got a rental property of his own, and I bet you him and his wife, they count those dollars that they get every single month, right? It's important to people when you have, especially if you have one or two rentals, right? That's what you focus on. That's the story you tell, right? That's what I want to say brag about, but if you've got something that's cash flowing really well, that's what you brag to your friends about, right?
It's the shiny stuff that everybody wants, right? It's what you see, it's what you can feel, it's what you get in your pocket every regular time, not what you it's liquidity, right? Liquidity has value. And
well, I'm super glad you said that because that's what I wanted to get into next was liquidity. And because I want to talk about the difference between cash flow and appreciation. And the first biggest difference is that liquidity, right? That you just mentioned. That cash flow is something I can spend right now, right? I don't think that you should spend it. I want to talk a little bit about what I think an investor should do with that cash flow, but you could spend it now. It's money in your hands. That appreciation, you can't go to an ATM machine and go pull that out.
Well, yes, but I would say part of appreciating your appreciation is not completely devaluing it as a partially liquid piece of your investment, because it can be leveraged and you can borrow liquid money against that collateral and use it essentially to make other investments or whatever you need. So not appreciating that it's not completely useless to you, it's not completely out of touch, can be a valuable thing to appreciate.
All right. So the next thing, one of the things I want to impart to people is, what do you do with this cash flow? If we're appreciating our appreciation, but what about the cash flow? Does that mean I just spend it? I put it into my family's budget and just spend it every month? I try to tell people to save it, put it in a separate account so you can watch it grow. If you need a new water heater on your rental property and you've got $5,400 in your rental property account sitting there, that $800, $1,000, $1,200 that you spend on a new water heater is not going to hurt quite as badly because it's not coming out of your family budget or your other resources. It's coming out of the resource that's meant to help maintain that property, A, and B, help you expand your empire and buy more real estate.
Yep. And there's a lot of ways to do that, but like you said, just keeping it invested. So I like to look at every rental investment or every real estate investment kind of like any other equity investment, right? It's an asset. It's an asset. These cash flows are dividends. If a lot of smart investors reinvest their dividends to make their appreciation grow faster, and it's no different with this. The asset appreciates because its value goes up. Its dividends give you more value out of it. So,
well, let's clarify. When you say dividends and all that stuff, you're comparing dividends that you would get from a stock or a fund or something like that,
or is
a cash out, right, that you get from that investment. So you're comparing that to cash flow is basically what you're doing.
Yeah, I mean, I'm comparing it because they're two words for the same thing, right? They're your asset paying you out money from its overages. Same thing a REIT does, same thing a stock does. Companies do it. It's a mindset of a way of looking at it, because if you look at it as an extra paycheck, you're going to use it like an extra paycheck. If you look at it as an asset dividend, you might use it like an asset dividend. Getting a little complex for a second, if your cash flows go into a money market account that is invested in a REIT and that's growing based off other people's real estate that you then buy your next real estate purchase with, it's double dipping in the market, right?
Kyle, you are opening up a whole nother podcast here.
Hey, I like to do that.
You didn't even define what a REIT is, and we're not going to do that today. It's a real estate investment trust, is what that is. By the way, it's another type of investment vehicle that you can use to invest in real estate, kind of like you would a stock. But we'll get into that. That would be a great podcast down the road. But let's talk about appreciation now. So this is about appreciating your appreciation. So the reasons why we want to appreciate your appreciation is because this really helps build your long-term wealth. That's what we're after, right? When I get to the end, I want to be able to say at some point, I don't have to work if I don't want to, right? Like, you know me, Kyle, I'll probably work to the day I die, but my hope is that I'm only doing it when I want to do it and how I want to do it, that fills up my life and fills up my soul. And I'm not doing it because I need money or I need to do it. And that's what wealth building is for, to get us to the end of life so we can enjoy it.
Yeah, and there's a common measure for something like that, and we call it net worth, right? Mm-hmm. And cash flows don't increase your net worth unless you're very smart about it, but from a measuring aspect, they don't. What it does is appreciation, owning real estate, owning assets, and a lot of people, net worth, the word net means, it's not gross worth or anything like that, but it confuses a lot of people because, like, going back to that $200,000 example, if that was your only asset, only worth to you, that net worth starts at zero. Well, over 30 years, your net worth with that same example is that $400 or $400,000 value of that home after appreciation. So it grows the mindset of net worth with your assets.
And it grows at a rate that you almost can't get any other way on a regular, consistent basis. You can get that kind of growth in the short term with some investment vehicles, but not on a consistent basis. And it's more of a flash in the pan when you do it with the stock market or some other investment. But really, I like to say real estate and a great business are really the only two ways to build wealth for you and your family long term.
Yeah, and I mean, it's one of those things that's generational, right? It's like that's the right. Stock market isn't new, but it's not thousands of years old. It's like there's no other market we have today that hasn't drastically changed over, generations and generations like real estate hasn't. It's stayed stable. It's always been a platform for wealth. It's been a platform for building wealth. If you own land, if you own real estate, but it's I'd call it recession proof through all of our crazy markets and the way the world changes so constantly. And even big business sees it, right? So it's a big reason a lot of our values go up, because the stable money, or what needs to be stable money, is trying to jump into it faster than you can. So,
and you know what? You mentioned this earlier, Kyle, but this is kind of our final point about appreciation. Improves your net worth, right? Affects your long-term wealth building, right? It helps you. It's the easiest and fastest way to do that for the long term. And you can leverage it.
It's a snowball effect. We've mentioned the potential for a snowball effect in your huge favor. We talked about it with the Setons episodes ago, building your empire, but you can use the asset's value, as that grows way past your debt or significantly past your debt, you leverage that equity to get more homes that will build you more value and just keep rotating that and snowballing. So people always say it's hard to get started in real estate. It is harder to get started in real estate than it is to continue investing in real estate, because once you're started, it can grow itself. It really can snowball. That's how we called that episode "Building Your Empire," because the empire gets built. If you put in the work.
And somebody like the Setons is a great example of what we're talking about, because they don't do anything, do they? I mean, they do stuff. Don't get me wrong.
No.
But beyond building their wealth and taking the wealth that they built and using it to leverage themselves and get more to grow their empire. But for their house on 123 Main Street, they're not doing anything.
What you're
they
saying
don't have to go there every day and work on it.
Yeah, what you're saying is they're intentionally and actively using
passive.
that snowball effect. All the new purchases and all the new properties they get, it becomes a quicker process, and it becomes a more scalable process, because they're just rotating that money back into the building of the empire. And yeah, you can find a stopping point, but if that stopping point's in 10 years and you're looking at your portfolio and you're like, I've never taken a dime out of this, that sucks. It's worth $10 million. It's the wrong word. It doesn't suck. You're not complaining about it. It's because you reinvested those dividends like they did.
Hey, y'all want to have some fun? Let's give some people some inspiration. Appreciating your appreciation, right?
Mm-hmm.
Let's talk about our appreciation. I'm going to start. Hey, Steve, would you be willing to share your experience with appreciation from your rental property with us?
Yes, I would.
Tell us, because I happen to know for a fact, and that your rental property, you only have one, right?
We have one.
And it's in California, which is a completely different market than what most people deal with. It's a very volatile market. So that's why I think it's interesting for people to hear a different perspective. When did you buy it?
1987.
Wow.
You know where this is going.
In 1987, I hadn't even graduated high school yet.
Okay.
All right. So do you want to share with us what you bought it for?
$99,000.
$99,000. You know what? I have a fun story. My parents bought, when I was 1 year old, they bought their first home for $17,000, like a 1,700 square foot home. Can you imagine that, y'all? And
we drive that around these days.
I think they sold it for $380 or something like that when I was like 14 years old. I mean, I'm probably getting those numbers off a little bit, but that's similar to what Steve's about. Steve, you have any idea what your value is right now?
Well, I know you're not supposed to go on Zillow.
What's Zillow tell you?
Zillow
That's
says,
all right. Go ahead.
Zillow says it's around $800,000.
Okay, so Zillow is actually pretty accurate.
Yeah.
If anybody's curious about Zillow, I have a definite opinion about it. And it's actually pretty accurate for you in California. It's very accurate. As a matter of fact, I used to use it all the time when I was in California. In Texas, it's not as accurate because we're what's called a non-disclosure state. So the data points that Zillow needs to create that valuation aren't there in Texas like they are in California. So you have built $700,000 in equity. Help me do the math, Kyle. What is that? 34 years? Is that right? Did I get that right? 34 years, 700,000. I would bet, Steve, that you have not done anything else in your life that has created as much wealth for your family as that house. Am I right?
That is correct. I'm getting
kind of personal, but
that is correct.
All right.
I mean, 800% returns isn't too bad.
Yeah, I mean, you might own that thing for another 10 years, and it might be worth $1.2 million by the time you need to sell it. And you may never need to sell it. Your kids might be selling it up. You know, who knows? But you're never going to, I don't want to say never, but so to this point in your life, you haven't done anything to do that. I want to go to another extreme. Thank you for sharing that, Steve.
Absolutely.
Well, and while he's on that, I imagine that was paid off since it's been 34 years, right? So
now his cash flow is even higher than it was when he had a loan. Absolutely. Good point. So, Kyle, do you want to share your age?
I got to remember it first.
Your age. You don't know how old you are.
I'm 25.
25 years old. So you're pretty young. You're pretty young in respect to other people that do what we do, right?
Mm-hmm. I get told that.
You're pretty young for a homeowner.
Yep.
And you're very young for somebody that has 2 properties. So you have your primary residence and a rental property, right?
That is correct.
So
2.5, but
let's talk about this. Well, that's true. So let's use a good example of your rental property. That's the first home you lived in, right?
Mm-hmm.
We've talked about this before. It was your primary residence, and you moved up to get something bigger, better, something else you wanted, and kept that as a rental property, which is a really smart move. If anybody out there thinking that's the easiest and best way to acquire your first rental property, right? Kyle, do you know the numbers on that house? Like what you bought it for? How long ago did you buy it? You're only 25. It couldn't have been that long ago.
Yeah, I bought it. I know all those numbers. I bought it in 2017. Bought it off market. So I got it for 110 with renovation costs, everything 140. So bet you want to know what it is today, 4 years later.
Wait a minute. Your purchase price was $110,000.
Correct.
Okay. Yes. What is it worth right now?
Well, the appraiser told me when I refinanced it and moved up that it was in the 260 range.
Okay. So you have built $150,000 worth of wealth. It sounds like you used $30,000 or so of your own money to create that wealth. So let's call it $120,000 in wealth
of leveraged money, but we'll get on that at
okay.
another point.
All right.
But
for $120,000 in wealth for you and your family in 4 years.
Yep.
This is an even better rate than Steve over here at this point. If you can keep doing that every 4 years, you'll when you're Steve's age, you'll be killing it.
Well, markets don't usually get expedited by the things that have expedited it in the last couple of years, but you never know. You never know, right?
You're absolutely right. They're not always the way they are, but the point we're trying to make here is that we've talked about planting your tree before. Just plant your tree because the appreciation is constantly happening, whether it's happening at a 4% rate or a 12% rate, doesn't matter. People associate the rate of appreciation to how good the market is. If it's more than 0, it's good, right?
Well, and people don't appreciate usually the one part you can appreciate in appreciation is the ability to get what you want, right? It's not always unseen. My first house wasn't my dream home. It wasn't the best thing I wanted at that time, right? A lot of people tell me constantly that if they can't get that exact house they want, quality they want, whatever, where they want, I'm just not going to buy anything. Okay, well, you're going to go rent somewhere that's definitely when you're renting, it doesn't even come into mind if it's where you want or anything like that, right? So you can meet in the middle or meet where you'd rent or whatever and buy that first house just to acquire it. And 3 years later, for example, like I did, look at a cost consideration of how do I get a better house, the better house that I want without spending more money per month or it not really costing me anymore. You rent it out.
Yeah, no, that's exactly right. If we use the car analogy, people understand the car analogy really well, don't they? So
yeah, but they don't appreciate their depreciation when we're talking about cars.
Cars depreciate, but to your point, because we know people that have done this. I know people that are looking right now that were looking at homes to buy for their primary residence 3 years ago, right? And now back then they were looking and they wouldn't buy because they were all Fords, Chevys, and Toyotas. Mm-hmm. And they were only looking to get into a Lexus, whatever, Mercedes, whatever it is they wanted, right? And now the Toyota, Ford, and Chevys are the cost of the Lexus and Mercedes and BMW, right? To use our car analogy. And they're out there still looking and still doing the same thing. If they don't ever plant their tree, they're constantly going to be in this vicious cycle that's just going to keep going.
Yeah, it's just like the compound interest argument of you have to start somewhere. You should start in your 20s, what everyone tells you. While that is true, it's because it's time. Time has value just like anything else. Well, if it's always a chasing game until you start. We live in America. We know that wages don't go up at the same rate of real estate market appreciation or inflation or any of those things, right? So yeah, I'll wait 2 years and then see where I'm at. Well, what you got pre-qualified today likely will pre-qualify you for less in 2 years. So now you're going to have to stretch again. And if you didn't want to make that stretch, right now, you'll probably be making a bigger stretch in 2 years and settling even more than you almost did now. And then wondering why you didn't do it now. And then looking at the appreciation you would have had if you did buy 2 years ago.
We talked about interest rates.
Yeah.
Get that tree planted.
And with planting the tree too, one thing that nearly no one looks at is if you don't like it, you don't have to stay with it, right? Say you put in that conviction and commitment, you ignore all these objections you have in your head and you go buy that property, and then 3 months later you think is a horrible idea, I should have gone and rented, but whatever it is, then go do that. Go rent an apartment and go to the decision you think you should have made and rent out your house. Well, 2 years later, you'll be looking back at that decision and saying, well, I've rented for the last 2 years. The only difference is I'm now appreciating the appreciation of buying that asset on top of any cash flows or anything else you get from it. And if you care about building credit, it helps you do that. There's all these pros.
All right, so I'm going to share a couple of appreciation stories of my own, and then I'll let you wrap this up. How's that sound? Because I think we killed this one, but I think it's fun. What people want to hear is Steve's story is fun, right? Your story at your age is fun, right? I hope that this inspires people. I personally, like my primary residence, just to throw some numbers out there, bought that for $250. I'd say I think it's worth about $480 right now. Okay. 16 years. That's pretty good, right? I put some money into it to get it there, but that's pretty good wealth building. Here's the key. I'm doing that over and over and over again, aren't I? Because the power of this appreciation multiplies. If Steve had bought 2 houses in 1987, he wouldn't have $700,000 now in wealth building. He'd have $1.4 million, right?
For an extra
and he'd have
cost
$1.6 million of real estate. He didn't know that back then, but so I have another house that I bought I have 2 houses in my same neighborhood. I bought for $150. I believe that one is now worth, last time I checked, like $325. I bought another one for $135 it's like $285. I mean, you start adding this up. Look what these houses are doing. They're not even talking about my Orange Beach condos. Those things have gone up over $100,000 in a few short months. And that's a crazy market right there. But I don't know any other way I could have done that. To be honest, I mean.
And we call this appreciating your appreciation because what you're doing right now is appreciating it. But you're not looking at it in your pocket. You're not spending this money. You're not, it's not making you feel on a day-to-day basis like you have all this more money to throw at stuff. If that's your dream, then work harder at making more money at your job or whatever, because that's not the goal of investments. It's appreciating the success of your investment and your investment goal. And when they're realistic, you can appreciate when they exceed that realistic
right, because down the road, I'm either going to take my cumulative empire and use that cash flow to live off of, or I might sell some stuff off. When I get to an age where I'm like, okay, I'm done. I don't want to do this anymore. I want to chill on a beach. I can sell one of my houses and use that to chill on a beach for the rest of my life. And fortunately, if you've got several houses like I do and some of our clients do, I could keep doing that. Right? Like, okay, ran out of money. Let's sell another house. I mean, that's the goal here, to get us to the end with as much wealth to either pass on to our loved ones or just to get us to the end so that they don't have, so we can enjoy our life the way we were put on this earth to enjoy it. And our loved ones don't have to worry about how they're going to support us and get us to the end.
Yeah, it's all a game of who takes advantage of what's out there, right? And as early as you do it, the better it turns out. Time is the most, in investing, time is the most valuable factor, always. Doesn't matter what avenue, what vehicle, any of it, time is the most valuable factor. And the more of it you have, the more of all those things you can acquire. Because like you said, you could sell all 5, but if they're all paid off, you could also pull all that money out of all 5 and let those tenants continue to pay it down. And now you got that money in your pocket and it's just starting over that process. But now you have the nest egg, right? It's a transfer.
And to your point, you are going to have a way better life at the end of your life. When you are 80, 90, 100 years old, looking back on your life, you're going to probably have a much more fulfilling life than I did, because you started this process and started planting your trees much earlier than I did, right? Where I'm going to probably have a much more fulfilling life than a lot of other people that aren't doing it at all, right?
Well, so like kind of what you're describing is a tug of war, right? And we making this sound like all the great parts of it and the great successes of it. It doesn't come without sacrifice. You need to, one, live within your means, but understand what your means are, right? Like, any time I was able to acquire more funds to plant these trees, that was my goal at a young age, so that in 5-10 years, I don't have to make those sacrifices that normal people make for 40-50 years of their entire life, right? It's a tug of war, but just like I was saying, time is valuable. You take a little bit of time now to execute your investment goals, you get a lot more time later to enjoy the fruits. Where if you try to enjoy fruits first, we all know how that ends.
That's right.
Credit card companies love it when you try to enjoy the fruits first.
Exactly. All right, close us out, Kyle. I think we killed this one.
We did, and great talking to you guys. Well, if one thing I did forget to mention, but probably the most important, is we are not financial advisors, and this is not financial advice, but we are always happy to talk to you about any of it or give you our advice or our experience and tell you how to build wealth with real estate.
We always have opinions, don't we, Kyle?
Yeah, they're just all just opinions. They're validated and no. But yeah, we'll end this one. Thank you guys for tuning in. Look forward to talking to you guys on the next one. If you want any advice, info from either of us, or just want to talk or see what we can make you on your portfolio or the portfolio you're planning, send us an email at showmethemoney@wearetpm.com. Give me or John a call. Find us on Facebook, the interwebs, Google, and anywhere else on the interwebs. So
show me the money at wearetpm.com. Love it. Good job, Kyle. Good one. We are TPM.
I think we're done.
Are we done?
Are we done, Steve?
Are we done, Steve?
Steve.
Are we going to try doing We Are TPM all together? I thought that's what this was for. I thought that was my cue to say We Are TPM.
All right, Q. We Are TPM. Guys, have a great week.